Hi, Ken Boy with Accounting Accidentally. This video is called The Visa Lawsuit and the Cost Volume Profit Formula. So the Department of Justice filed a lawsuit against Visa, and we've got the details here from NPR. Accuses the company of illegally monopolizing the debit card market and therefore driving up prices for businesses and consumers. There's not enough competition. They control the pricing. They're driving the price up. Visa handles more than 60% of debit card transactions in the US and collects more than $7 billion in annual processing fees. The company allegedly used its market position to stifle competition and keep prices artificially high. This is what they're accused of. So let's think about what types of companies process lots of credit card transactions. This is from a source called Clearly Payments. Not surprisingly, online shopping and e-commerce, food and beverage, restaurants, cafes, bars, and retail. So let's use that information to think about the financial impact if Visa was forced to lower their fees. So if you're a restaurant, bar, and online processor, a big portion of your costs may be Visa fees, credit card fees. In fact, you're going to incur them with every transaction, which is why they're variable costs. If Visa cut that cost, that variable cost, that would change the profitability of your business and give you more flexibility. So this is the cost value profit analysis that I mentioned before. So here's the formula, and I put it color-coded so you can see more easily the components. Profit equals sale price, price per unit times units sold in green, less variable costs times units sold in red, less fixed costs in brown and total dollars. So for this example, let's assume an e-commerce business is selling hiking boots. The sale price is $120, variable costs per unit total 80. Fixed costs are $150,000. That doesn't change. Units sold 5,000. So using the Visa example, what if you were able to cut $2 per transaction per unit sold out of the cost because you were saving on Visa charges? So what if variable costs go from 80 down to 78? You can see that the profit increased from 50,000 to 60,000. That also means that you could cut the price of your product and still maintain the same profit, give or take. So what if you cut your price, you save $2 on variable costs. What if you cut the sale price $2 from 120 to 118? You're back to the $50,000 profit because you have lower costs. You could also cut your sales price. It makes you more competitive. So these are the kinds of decisions that you can make, almost like on the back of a napkin, when you're able to cut a variable cost. Now, it's important to remember that fixed costs don't change. You always have to cover those fixed costs. That's your first goal. And the lesson here is lower variable costs per unit. You can lower your sales price per unit, come up with the same profit, and still cover your fixed costs. So the lesson here is that if you can lower variable costs, you can use the cost volume profit formula to make some decisions, including cutting your sale price and maintaining the same level of profit.